For as long as they have existed, central banks have been the target of resentment from politicians, conspiracy theorists, other banks, and regular people just trying to make their repayments. But a detailed look at their turbulent role throughout history does show that sometimes this anger is not necessarily misplaced. In several cases, a system that was supposed to make an economy more stable actually just ended up creating a single point of failure that was simultaneously too big to fail and too big to bail. So then, why is today any different? These institutions have routinely been installed without much consideration to the people they will be serving, and given a job they might not even really have the ability to do. Maximum employment and price stability are respectable goals, but have prices really been more stable and employment more consistent since these banks became a common feature of almost every economy in the world? It's a simple critique that these institutions should have an answer for, because on top of all of this, they are once again coming under attack around the world for apparently not doing this simple job correctly. Potentially even worse is that some governments, not looking at anybody in particular, are figuring out new ways to circumvent their influence entirely, for better or worse. But maybe the problem lies in the fact that this was never really supposed to be their job in the first place. The early central banks, if you could even call them that, operated very differently to the banks of today. And they were established to try and solve one simple problem. Back in the early 1600s, the money problem in Europe wasn't subtle. It was repetitive. Wars kept breaking out, armies kept needing to be paid, and rulers kept discovering that their tax system was basically a slow-moving argument with their own population. So, borrowing filled the gap. Private merchants, goldsmiths, and bankers had capital and cross-border networks that could move funds faster than states could raise money through taxes. Governments had legal power, meaning they could levy taxes, change the rules of repayment, enforce contracts, mint coin, and declare what counted as legal tender. That power mattered, but it didn't magically produce cash on the day payrolls due. A government's treasury could have authority on paper, but still be empty in reality. Lending worked during calm stretches, then a harvest failed, a battle was lost, a rumour spread, and repayment suddenly looked a lot less guaranteed than it did the month before. Defaults happened, credits vanished, and in those moments, trade slowed down fast. People still needed goods, but nobody trusted the payment system enough to take the other side of a deal. Over the long run, commerce still expanded, and that made the payment mess harder to ignore. Coins came in different weights and values, money got clipped and debased, and the same coin could be worth less simply because it had been shaved down or diluted since the last time you saw it. Merchants needed settlement systems that didn't rely on daily arguments over which metal disc counted as real. That pressure produced early, central-ish institutions. The Amsterdam Wisselbank was founded in 1609 and let merchants deposit coin and settle payments by transfer, and was backed by the city, which made trade easier to trust when coinage was unreliable. Sweden's Riksbank followed in 1668, building on earlier experiments, and it became a clear example of a state-linked bank anchoring a national system. These institutions weren't modern central banks, but they showed what the era needed: a trusted place to clear payments, and a way to stop money from turning into a weekly fight. The version that ended up becoming the model everyone copied, though, was in England. The late 1600s were turbulent and expensive, and the English government needed a reliable way to borrow at scale without restarting the entire process every time it ran short. In 1694, during the 9 Years' War, Parliament approved the Bank of England through a bargain that was straightforward in its incentives. Private groups lent the government large sums up front, and in return, they received a chartered bank with special privileges and a central position in the financial system. The Bank of England helped the government to borrow money more smoothly, so it wasn't starting from scratch every time it needed cash. It also printed its own notes, and people actually used them because they trusted a big chartered bank more than some random private IOU. Over time, the Bank of England became a key hub for payments and settlement. which meant debts could be cleared and trade could keep moving even when smaller banks got shaky. This was the financial plumbing that was needed. It reduced friction in trade. It made it easier for the state to keep financing itself without the whole system freezing every time confidence took a hit. Yet, the central role of the bank came with a predictable side effect. Power concentrated around the institutions closest to the centre. The safest money and the easiest credit intended to flow first through the financial hubs, then outward through smaller, more fragile banking networks. In England, access to the safest channels depended on proximity to the Bank of England and the privileges built into its charter. Who could use its notes, who could settle through it, and who could tap into it in a squeeze. Everyone else operated further out, where debt was shakier and usually more expensive. Naturally, suspicion followed because the arrangement was obvious in plain sight. The Bank of England helped finance the government, received special privileges in return, and then sat at the heart of the system. Central banking started as a state of survival, but the next major shift came from a panic. Early deposit banking often started with a simple service. People handed over coin for safekeeping. The bank stored it, and then they settled payments by moving entries in a ledger instead of dragging metal through the streets. Storing coins and vaults and keeping paper records of that were the product. Over time, private bankers and even some big institutions saw that most deposits sat still on most days, which meant a large pile of coins was doing nothing. Lending grew out of that temptation. Keep enough cash on hand for normal withdrawals and lend the rest out to earn a return.
That later became known as fractional reserve banking,
which was a great way for banks to make money, but it introduced a new, unforeseen problem. If too many people demanded cash at once, the bank couldn't hand it over immediately, even if it was fine on paper. Bank runs turned individual bank problems into system-wide problems. Liquidity became the difference between a bad week and a full-blown collapse. The Bank of England became more of a firefighter over time, getting pulled deeper into crisis response because it sat at the centre of the financial system. When panics hit, the goal was to get cash into the right place fast enough so that a bank run didn't turn into a chain reaction. By the 1700s and 1800s, a lot of countries adopted some version of the same arrangement. A special bank with a special relationship to the state, sitting near the centre of payments, with an implied responsibility to keep panic from turning into a total shutdown. For most governments, that trade-off was worth it. They wanted stability, even if it meant creating a powerful institution at the centre of the system. The United States looked at the same model and saw a threat, which is why America's central banking story starts with a fight. The country had just broken away from an empire, so anything that looked like concentrated power, especially concentrated financial power, instantly triggered suspicion. A special bank sounded like the old world showing back up with a fresh coat of paint, privileges, insiders, decisions made far away from the people who would feel them. In 1791, Congress chartered the first Bank of the United States that would last for 20 years. It was meant to help manage government finances, support a more stable national currency, and bring some order to a young financial system that was still a patchwork of local banks and local currencies. Yes, there wasn't just one unified currency at this point. Many states had their own currency, which, as you can imagine, is chaotic. But for some reason, people are still trying to bring that idea back to life today.
Like I was saying, it's FTX. It's a safe and easy way to get into crypto.
I don't think so.
Anyways, supporters saw it as a basic infrastructure, but critics saw it as a gift to the elites and the federal government. A way to concentrate power and influence through loans and contracts, disguised as stability. When the charter came up for renewal in 1811, that suspicion won and Congress let it expire. The timing mattered because the country almost immediately ran into the same problem again. The War of 1812 made it harder for the government to borrow, and it made the money system feel a lot less stable. So in 1816, Congress chartered the Second Bank of the United States. It had the same basic purpose as the first one, but with a clearer role in keeping the banking system from spinning out. It held government money, it helped the government borrow, and it tried to put some rules around the chaos of local currencies by forcing banks to back up their promises. When the second bank tightened up loans, it was trying to stop the whole system from turning into one giant pile of shaky promises. But to a lot of people outside the big cities, it felt like a powerful institution deciding whether your town got easy money or got squeezed. That was the core argument, and it never really went away. Loans decided who bought land, who survived a bad year, who expanded a business, and who got crushed by interest. Big merchants and big lenders wanted a system that made loans reliable and debts enforceable. Farmers and small borrowers often saw tight money as a system built to keep them in line. Most central bank arguments were really arguments about who got a calm interest rate and who got a brutal one. That fight exploded in the 1830s. Andrew Jackson turned the second bank into a symbol of concentrated power, vetoed its recharter in 1832, and then pulled federal deposits out of it. By 1836, the charter was gone. What followed wasn't a calm era of financial freedom. It was a more scattered system with a lot more banks, and a lot of different rules, and a lot more ways for panic to spread. The country lurched through repeated crises, where confidence snapped, people ran to pull out cash, and loans tightened overnight. Regular people paid for it in direct ways. Savings got wiped out, wages went unpaid, small businesses folded because one rumour could turn into a run, and a run could turn into a bank closure. Over the 1800s, reforms came in pieces, and the federal government pushed toward a more uniform currency and a more organised banking system, especially around the Civil War. Yet the deeper weaknesses stayed. A huge country with a scattered banking setup still had a habit of turning fear into a chain reaction. The breaking point arrived in 1907, when a financial panic showed how much the system still depended on improved resources and private coordination to survive. After that, the conclusion became harder to avoid. The country needed some kind of stabilizer, even if it hated the idea on principle. So in 1913, the Federal Reserve was created as a compromise. The Fed, as it's referred to, was meant to make sure there was enough cash in the system when demand suddenly spiked, lend to banks in emergencies, and smooth out the seasonal money crunches that hit every year. It was not created to fine-tune unemployment or chase a perfect inflation number. It was created so that the system wouldn't keep eating itself. But even with a central bank in place, the US still hadn't decided what it actually wanted that bank to do. That job description was going to be rewritten by war, depression, and political argument over who pays for it all. After the Fed was created, it still operated in a world where the government could lean on it whenever the stakes were high enough. The Great Depression was the first time that pressure became unavoidable. The economy collapsed, banks failed, unemployment exploded, and the public wanted relief. Bank runs spread, people pulled cash, and the financial system started acting like it might not survive the decade. Crises always changed priorities, and keeping the system alive mattered more than keeping prices perfectly stable. So, interest rates were pushed lower to make borrowing easier. The government also built new guardrails around banking, including deposit insurance in 1933, because trust us had just stopped working. The Fed's role shifted closer to emergency support and recovery, because the alternative was repeated collapse. World War II took that relationship and made it even tighter.
The US had to raise an enormous amount of money quickly.
And the cleanest way to do that was to sell a mountain of government bonds. High interest rates would have made that mountain heavier, so rates were pushed down and kept down. The Fed backed that strategy by helping the Treasury sell the bonds and by keeping borrowing costs capped during the war years. But that choice came with a trade-off. Cheaper borrowing helped fund the war and the post-war transition, and tied the central bank to the government's financing needs. Inflation pressures could build, and the Fed still had to think about what higher rates would do to the government's budget and to the politics of paying for the war. The main conflict was already baked in. Governments with big debts like low interest rates. Cheap debt for the state competed with stable money for everyone else. After the war, inflation rose in the late 1940s, and keeping rates locked down forever started to look like a long-term problem. The Korean War era brought the conflict back again because borrowing needs stayed high while inflation fears returned. Pressure built for the Fed to have more room to raise rates when prices were rising too fast, even if that made the government borrowing more expensive. The Treasury-Fed Accord of 1951 was the turning point because it ended the Fed's job of permanently keeping government bond rates low. This was the era when central bank independence started to mean something real. Politics still never disappeared because the Fed was created by Congress and could be reshaped by Congress. Independence mainly meant the Fed had more room to make unpopular choices without day-to-day political control over interest rates. That was a political arrangement designed to solve a political problem. Someone had to be willing to slow things down when inflation ran hot, and elected officials were rarely eager to volunteer for that role. Independence also created a kind of cover. When higher rates caused pain, the blame could be aimed at the Fed, even though the broader direction of the economy was still being set through laws, taxes, spending, and elections. For a while, the arrangement looked like it worked well enough. Post-war growth was strong, unemployment stayed relatively low, and the Fed's image shifted towards expert management. Then the 1970s hit. Oil shocks, policy mistakes, and a changing global economy pushed prices up, while unemployment also rose and the old assumptions broke down. By the 1970s, the economy was breaking the rules of the textbook, and Washington's answer was to hand the Fed a job description that sounded great on paper, but did not come with clear instructions. So at that point, the Fed had a bigger role than ever, and the country had bigger expectations than ever. But nobody could agree on what the job actually was, or what success even looked like. And that is where this whole story really starts. So it's time to learn how history works to find out why we still don't know what the central banks are supposed to do, and why politicians still can't stop trying to influence them even after they built the whole thing to keep their hands off it. This week's video is sponsored by Mint Mobile, a wireless company that's all about keeping things simple and affordable. Mint focuses on fixing what feels broken with wireless. Everything is done online, with no stores, no salespeople, and no confusing hoops to jump through. Right now, Mint is bringing back their biggest holiday deal of the year with 50% off their unlimited premium wireless plan. That includes unlimited talk and text, coverage on the nation's largest 5G network, hotspot included, and free calling to Mexico, Canada, and the UK. What stood out to me was how easy switching actually is. I kept my phone number, activated my eSIM in minutes from home, and didn't have to overpay for data I don't need. The service has been fast and reliable everywhere I've used it. Mint also does something different with pricing. You can buy wireless in bulk with 3, 6, or 12-month plans. So the more months you choose up front, the more you save. And if you already have an unlocked phone, you can bring it with you. And for a limited time, you can get 50% off an unlimited premium wireless plan from Mint. Lock in Mint's lowest price of the year and pay $15 a month for a 3, 6, or 12-month plan when you switch at mintmobile.com. When the 1970s hit, the economy stopped behaving the way people expected, and suddenly the Fed's job went from background plumbing to national obsession. For years, policymakers leaned on a simple relationship. When jobs were too easy to get and the economy was running hot, prices usually rose faster. And when the economy cooled and unemployment rose, price increases usually slowed down. It wasn't a perfect rule, but it was a rule people thought they could use. In the 1970s, the rule didn't fit. Prices rose quickly while unemployment stayed high, which meant families were getting squeezed twice, money bought less, and work felt less secure. That combination would later be called stagflation, but in the moment it just felt like the system was failing. Congress wanted a clearer way to describe what the Fed was responsible for, and a clearer way to judge it because "we're doing our best" does not survive a cost of living crisis. In 1977, Congress updated the Fed's goals, and in 1978 it added stronger reporting requirements, tying the Fed to maximum employment, stable prices, and moderate long-term interest rates. Most people only remember the first two and call it the dual mandate, even though the third part was sitting there the whole time, quietly reminding everyone that long-run borrowing costs matter too. The wording sounded simple, but it was not specific.
Maximum employment wasn't a specific number.
Because maximum kept changing depending on the decade you were living in. A job market with factories hiring non-stop looked different than a job market with automation, global competition, an aging population, and a whole lot more people stuck piecing together work that didn't come with stability. Even the unemployment rate could mislead you because the headline number is built on rules about who counts. The unemployment rate is basically the share of people without a job who are actively looking for one out of the people who are working or actively trying to work. To count as unemployed, you generally have to have no job, be available, and have looked recently. If you stop looking because you're discouraged, you can drop out of that number entirely, which means the unemployment rate can fall for two totally different reasons. More people got jobs, or more people stopped being counted. That's why there are other measures too, including people stuck working part-time when they want full-time, because technically employed isn't always the same as doing fine. Stable prices wasn't specific either, because stable depended on what you were measuring and how long you were measuring it for. Stable over a month is different than stable over a decade. And stable for a headline number can look very different than stable for what people actually feel week to week. Inflation gets reported as one clean headline, but that headline comes from a shopping basket where different things get different weights. Those weights decide what the number cares about, which means the same inflation rate can feel totally different depending on whether your biggest bill is rent, food, gas, childcare, or healthcare. So, the mandate became a polite way of saying, you're going to have to choose. If inflation ran hot, the Fed was expected to raise rates and cool things down. If unemployment rose after that, the Fed was expected to reverse course and help the job market. Those demands point in opposite directions, and the mandate did not tell the Fed what to do when they collided. The practical problem was the toolkit. Most of the time, the Fed had one main dial: short-term interest rates, plus the ability to shape expectations through communication. When the dial went up, loans got more expensive and spending cooled over time, which usually slowed price increases. That same move could also slow hiring and push unemployment higher. When the dial went down, loans got cheaper and recessions could be softened. But that same move could also push prices up faster and encourage the kind of risk-taking that only looks harmless right before it isn't. The 1970s and early 80s made this impossible to pretend away, because bringing inflation down required tightening hard. Tightening hard meant pain, and it showed up in layoffs, bankruptcies, and households doing the maths on what high rates did to their monthly payments. Politicians wanted inflation lower and jobs protected, and they wanted both immediately because that's what voters wanted too. Out of that era, a cleaner-looking idea started spreading because it gave everyone a scoreboard. If stable prices was vague, pick a number for it, commit to it, and judge the central bank by whether it hits that number or not. Over time, the number that kept winning was 2%. New Zealand was one of the early movers around 1990 that made an inflation target a formal public goal, and other central banks gradually copied the setup because it offered clarity. The Fed didn't write down 2% as its official long-running goal until 2012, but once it did, the number became a reference point. A small positive target had practical reasons behind it. Zero inflation leaves no buffer, and if prices start falling across the economy, people delay spending and debts get harder to pay back. A little inflation also fits how wages and prices move in the real world because people notice pay cuts instantly, and they often don't notice that a raise quietly failed to keep up. The politics behind all of this had never left the conversation. Borrowers and lenders didn't feel it the same way, since inflation makes old fixed payments easier to pay back, and makes those same payments worth less to the lender. Workers and asset owners don't feel it the same way either. Wages often fail to rise as fast as the prices of basic living necessities, while inflation often rises stocks and real estate prices. We say we're fighting inflation, but we rarely ask whose prices we're most worried about. Different countries also wrote different job descriptions, which is how you can tell this was never one universal model. The European Central Bank put price stability first. The Bank of England worked with goals set by the government, and the Fed had its broad goals written into law, which meant constant balancing and constant opportunities for politicians to accuse it of failing one goal or the other. If you design an institution whose job is to disappoint someone in every meeting, you shouldn't be surprised when it's always unpopular. The next step is predictable too. Politicians want a hand on the wheel, and public asks why the people setting the price of money aren't elected. That fight isn't new, and it isn't left versus right. It shows up anywhere elected government exists. Politicians live on election cycles, so they prefer growth now and low interest rates now, because cheap loans feel good and pain tends to arrive later. Central banks are supposed to think longer because inflation and bubbles usually show up after the party, not during it. When money is cheap and the economy is booming, central banks fade into the background and politicians take credit for the good times. When rates rise and borrowing gets painful, central banks become the villain and oversight suddenly becomes urgent. Pressure gets loud at inconvenient times, right before elections, or right after inflation starts hitting people in the checkout line. In the early 1970s, US President Nixon pressured Fed Chair Arthur Burns to keep monetary policy loose heading into the 1972 election. This while inflation was already a problem at the time. Turkey showed a more direct version. President Erdogan pushed for lower borrowing costs even as inflation rose, and central bank governors were removed when they resisted. The outcomes were not great. The lira fell, inflation surged, and people started to lose trust. Argentina made similar moves. In 2010, President Cristina Fernández de Kirchner moved to use the central bank reserves to pay government debt. But the central bank chief, Martin Redrado, refused, and he was forced out. That's why independence never meant what people pretended it meant. Central banks are created by laws, and laws can be rewritten, so independence lasts only as long as politics allows it. The 2008 financial crisis pulled central banks deeper into politics again. Rates went near zero, central banks bought huge amounts of government bonds and other assets, and governments ran emergency spending, while central banks tried to keep borrowing costs from going up. The pandemic in 2020 tightened that relationship even more, because governments needed to spend fast and central banks were asked to keep the money system from freezing. This was great because it kept the economy afloat, but it also helped the people that didn't really need helping. Very low rates helped stop a deeper crash, but it also pushed the stock market to record highs. If you owned assets, inflation showed up in your stock returns. For others, it showed up as higher rent. So, we've ended up with central banks that are blamed for problems they can't directly fix, praised for booms they didn't fully create, and constantly second-guessed by politicians who keep rewriting their job description mid-flight. And that leaves the obvious question: what job are they actually supposed to do? So what job should central banks actually have, if we're being honest about how we got here? They started out as tools for state finance and crisis response. They helped governments borrow, helped the payments system keep working, and stepped in when panic threatened to take the whole thing down. Then over time, we turned them into independent experts with big goals attached. Keep prices stable, keep employment high, keep long-term borrowing costs reasonable, and also somehow stop the entire system from breaking every decade. That's how you end up with an institution that is part firefighter, part referee, part therapist for markets, and part punching bag for politicians. Two things can be true at once. It's completely reasonable to demand transparency and accountability from an institution that can move the cost of money for an entire country. And it's reasonable to ask who actually wins and loses when rates move or when markets get rescued. It's also unrealistic to expect one committee to fix housing, inequality, job quality, and every global shock with one main dial. Interest rates can slow spending or speed it up. They can't build homes, train workers, or untangle supply chains. And this is why economists don't agree on what the right central bank job is. Some economists argue central banks should focus on a narrower mission, mostly keeping inflation under control and stepping in during panics, while elected governments handle jobs and living costs through taxes, spending and laws. Others argue that's too narrow because modern crises don't stay neatly in their lane, and central banks should openly treat financial stability as part of their job, meaning they watch bubbles, banks, and risk-taking before it turns into a collapse. Some economists say that the problem is the target itself, and they propose different scoreboards like targeting overall spending in the economy, so the central bank is not forced to choose between jobs and prices in quite the same way every time. Others say the inflation target should be higher than 2%, so there's more breathing room in a crisis. And others say that's a dangerous game because once you raise the target, you teach everyone to expect higher prices forever. So there isn't one clean answer that makes everybody happy. Optimal sounds nice until you remember the central bank is making decisions in real time with incomplete information while the economy is being hit by shocks it didn't choose. Oil, wars, pandemics, housing shortages, politics, you name it. The right move depends on what kind of problem you're actually in. And you don't usually get a label on the screen saying which one it is until after the damage is done. People love to say the central bank should just do its job. The problem is we've laid so many jobs on top of it that someone is almost guaranteed to feel like it failed. So the next time a rate decision blows up your timeline, it might be worth asking a slightly different question. Not just did they get it right, but why did we decide to put this much of our economic life in the hands of this one institution in the first place? And if you want to see what those trade-offs look like when they turn into real pain in the real economy, go watch our video on what kind of recession you actually want, because there isn't a painless option, only different kinds of pain. And don't forget to like and subscribe to keep on learning how history works.